Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. The TSX ended the week higher, but the New York stock exchanges took a hit. Oil prices are climbing into record territory, and commodities are also skyrocketing. Publisher of the realestatetiming.com newsletter, Robert Campbell, checks in from San Diego. He explains why real estate is so much easier to predict than the stock market. He also talks about inflation, interest rates, and safe places to protect your money. Vancouver realtor Steve Saretsky talks about what used to be the most expensive real estate in Canada. Even with record prices, people still want single-family homes, but few are available. However, the market might have peaked with bidding wars coming to an end. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.ZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to the show, Ross.
Well, it's another one of those big weeks to be coming back from. I mean, you think that momentum could only build to a certain degree, and guess what? We're into the next stage.
A different story on Friday in the U.S. and Canadian exchanges. The TSX ended on a winning note. The New York stock exchanges were down. Can you explain the difference there?
The NYSE, I mean, you take a look out there, the more and more that I compare this once again back to the 2000, the dot-com, the rollover of those just highly unrealistic expectations in terms of earnings. And commodity prices had generally been low and were just starting to come back. And what you ended up with was this move to all the higher grade items. I mean, if you look around today, the U.S. areas that have been holding up, energy, which makes sense, but it's a small part of the complex, staples, healthcare, utility. But as soon as you get away from sort of that group of 4 or 5 items, most of that U.S. market is just heavy and looking heavier. We've recommended selling into anytime you've got a little retracement rally and the RSI got up around 40 to 50. It would be an opportune trade just for the downside for each one of these lakes that we're having right now. So U.S. side, the mix there as far as the indices are concerned tends to keep them heavily weighted into sectors that right now are out of favor. Come over to Canada, my gosh, it doesn't matter what you really want to look at here. Banks are holding in reasonably well. The commodity sector, when you take a look at the base metals, you got copper, which had been consolidating for the better part of 11 months. Nice consolidation against long-term moving average support just came across, and the Bollinger Bands narrowed in nicely, so you got this little squeeze pattern, and copper's come to life and back up around the all-time highs. You got the same thing over in aluminum, zinc, and nickel, starting to get some pretty big action, and just the severity of it, the action here in this last week puts some of those into our exhaustion style mode, where if you've been going up methodically and you consolidate in broad ranges, you tend not to get these extreme readings that produce the final tops. But when you start to get day by day movement to the upside, accelerating and not giving back, that's when you're getting to the final stages, at least before a decent correction is ready. So We've got some of the commodities starting to get into that category. Not enough of them yet that I would say that it's all over with. Even crude oil this week, huge week. We've been targeting for 2 years $103 price. Managed to plow through that at the beginning of the week and close up at 115. We've got an upper target with the 134 to 139. That's just extrapolating back off of the old highs that we had at 145. But, who knows whether that's going to be the top. At this point, I'd like to see it turn into more of an exhaustion signal where we get the gap ups on the tail end of the move, and then that really provides for a decent downside correction. But for now, trends are up, and geez, you don't want to fight these kind of trends.
Now, I've heard the price of oil is so high, not because there's a shortage of it, but because the insurance for the tankers is now so high.
Well, yeah, and then again, too, some of these tankers are not being allowed to dock. They cross an ocean and they're being told, sorry, you can't stop here and unload. So this is just turning into a real mess out there. I don't want to second guess, what the politics of all of this is, but there's no question at all that the supply situation is just getting to be horrendous. And the fact that, they thought they might come up with another little bit out of the reserve out of the U.S. I mean, it's ridiculous. We're talking about, another day and a half worth of supply. Come on, guys, think about the big story. Let's get some pipelines and other things happening.
Why is the Canadian dollar below 80 cents when oil prices are so high?
Okay, you tell me.
Well, you're the expert.
I'm the guy who looks at commodities. It says, the Canadian dollar should react as a commodity currency. And 99% of the time it does. And those few times that it doesn't are what we consider to be a big red flag, or a green flag as it might be. It's quite often the bottoms. You'll find that the dollar is holding up very well relative to the commodities. But where we are right now, you've got not a short-lived move here in these greens and base metals and even lumber price now back up a bundle here. You've got all this good stuff happening, and the Canadian dollar just cannot manage to get a bid. So my theory here will continue to be that until you can see the divergence taken care of, the next easy move on this Canadian dollar is definitely quite a bit further south than we are right now. So luckily, most of us aren't traveling down south these days, so it's not as big a nut to crack as it would have been.
Now, commodities like wheat, they've skyrocketed. What's the story there?
Well, okay, so you've got problems first of all with supply of your fertilizers, etc. So your potash, nutrient, these two items have just had massive moves. You take a look at the price of wheat's up 50 to 77% in the last month, depending upon the contract you look at. Corn's up 25%. The fertilizer companies like Nutrien and Intrepid up 40 and 79% in just 1 month. We're talking 4 weeks here. Massive upside moves there. And, all it takes is a little bit of a change in the supply-demand equation, like you've got with things happening in the Ukraine right now. And don't forget that Ukraine was the breadbasket of Europe for, decades, some centuries. So to lose some of that production due to all that's going on right now, and potentially through, the following months, just has a huge impact when it comes to the pricing of commodities when you already have a really tight market out there. So some of these stocks are starting to get pretty impressive and on the upside, but gosh, as I say, don't fight the trend. The last item we might look at in the precious metals, been from that end of January We were January 28th, actually, we had our springboard alerts simultaneously, oversold alerts as far as gold and silver were concerned. And at that time of the year, you typically would end up with a rally that would take you out 2 to 4 weeks. So it gave us an optimum time window out into the middle of February, which is, we're just 10 days away from that at this point. The move, even though it may feel like it's had some pretty big days in it on gold, I mean, we are up about, $1,800 off the lows right now. But the action in the last week or so has been pretty methodical and pretty hard to put on higher lows. So it's just grinding its way up slowly. And I would suggest that if we either spike for maybe 3 or 4 days, that could be the tail end of the move. Or the fact is that by the time we get through to the 15th of February of March, the odds of us rolling over and correcting in gold are, well, actually, when I go back to the 1970s, other than years where you were troughing out and just starting to come to life, years where you'd already been in uptrends like we are right now, I think there was only about 3 of them since 1970 where gold managed to hold up through the second half of March and not have a decent correction back to at least the 50-day average. So really, at this point, thinking cautiously on the precious metals, probably with tight stops, no more than, say, the lows in the previous 2 days, just trail that up underneath and, try and lock in some decent numbers from when we were down at 1785.
Ross, thank you so much for the update.
Always a pleasure, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Find him on Twitter at chartsbyross. Coming up, Robert Campbell, next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Robert Campbell, author of Timing the Real Estate Market and the Campbell Real Estate Timing Letter online at realestatetiming.com. He's speaking to us from beautiful San Diego. Bob, welcome back to This Week in Money.
Oh, thank you very much.
When will the next issue of the Campbell Real Estate Timing Letter be published?
I'm working on it right now, Jim. The March 15th, 2022 issue. Working on it right now. And there is so much to think about, to report on. Not only real estate, the real estate trends, when to buy and when to sell, but also, the macro picture in the world right now. I mean, that has an overbearing influence on everything. You just can't stick your head in the sand and say, I'm only going to watch real estate and be ignorant of the fact what's going on in the world, because, that may be the straw. That's probably the straw that's stirring the stick.
Is your book, Timing the Real Estate Market, important for identifying trends?
Absolutely. It's a guidebook for identifying trends. So whether you live in Canada, the United States, or any other, free market where real estate is bought and sold, that it tells you exactly what to do. It's all about supply and demand and indicators that are the early indicators to coming changes in trend. It's kind of like a smoke detector. Before your house burns down, the smoke detector goes off, and you have a chance to get out and save your life. That's kind of what it is with these indicators. You have a very, very high probability of knowing, when the trend is likely to change from up to down or from down to up, and that's your edge. I was walking our two beagles the other day, and we were in this little commercial center, and somebody looked at me, and he kind of looked at me. I could know he was looking at me, and I just smiled at him. He said, I know you. I go, how do you know me? He goes, I bought your book. I said, really? Thank you very much. And I said, you should read that book real carefully. I said, that'll give you a big advantage in the world. And he was kind of a younger guy, maybe like 25 or 30. And he goes, I know. And he goes, I am. I'm downloading my own data. And I said, good for you. I said, that's the way you get ahead in the world. And so, I mean, I get recognized. I've sold 31,000 copies of it. So it's not like it's, something that I've, just self-published and sold 50 copies because nobody wants it. But it's very satisfying, Jim. You know how satisfying that is? And that book was published 20 years ago. And it's as accurate today as it was then. I haven't changed a thing. It's just supply and demand. Once you have a handle on supply and demand, that's the most predictable principle in the world. So, I mean, you apply supply and demand to these key indicators, and pretty soon, and apply some, momentum statistics to it, and it works great. So there's your edge. And I tell people, I don't care what you invest in, whether it's real estate or stocks or gold or bonds, don't play the game if you don't have an edge, because other people will take your money. You're not gonna make money playing another man's game. So you gotta make it your own game. And if you don't have an edge, get into a market where you do have an edge.
What do you see ahead for the stock markets?
The stock market is really, really difficult to predict. Real estate is way easier. In fact, guys, I learned how to track the real estate market and predict coming trend changes in the market 3 months in advance of their occurrence by investing in the stock market for 40 years, for 30 years. I've been an investor my whole life. I just applied the same principle that nobody else has ever done, and I went, wow, this works great. But the stock market can do what it wants to do. I'm a real estate guy. I like making my money in real estate. To me, I have a huge advantage. I have a huge skill set. I know how to build. And so that's my edge, guys. I'm not going to play the stock market. I mean, this is how I've, earned my living and that achieved some degree of financial comfort, more than most. And I do it something that I know, and I know real estate. Do I play the stock market? Yeah, I play the stock market. It's kind of a pastime for me. I developed a system where I make 1% a month. Right. Do I have my serious money in that? No, because I don't like trading the stock market. But if I do play the stock market, I have an edge. And right now I'm in the stock market. I have half of my Roth IRA divided into 2 different groups. One, commodities, half. Other 50% in gold. Why did I choose those? And those are buy and hold. Because I know what happens during inflationary episodes. Just study history. What goes up? What outperforms during an inflationary episode? Gold and silver. By a mile. By a mile. The U.S. stock market, for example, from 1970 to 1980, inflation averaged 9% per year. The U.S. stock market lost 50% of its value when adjusted for inflation. 50%. Does that mean that the stock market isn't a good investment at times? No, that's exactly wrong. Where the U.S. stock market is not a good investment is during periods of high inflation. Then you have to switch asset classes. Then you have to go to commodities. Then you have to go to gold. And interestingly, in the United States, and how does real estate compare? Because that's my area of expertise. During the 1970s, from 1970 to 1980, U.S. inflation, as I mentioned before, averaged 9% a year. U.S. housing prices went up 9% a year. That was their average. So in other words, it was a push. You didn't make any money, nor did you lose any money. Which is, there's nothing wrong with that, except if that's all the money you have and you don't have much of it. It's certainly better holding your own than losing. But was that the most opportunistic place for your money? Not at all. It was commodities and gold. And I presented those facts to my subscribers in my last timing letter, where to have it. And I'm one of those guys that when I say something, I eat my own cooking. So that's where my money is right now. And commodities the last year, by the way, for those of you that don't follow it, this is unleveraged. Commodities last year have gone up like 45% a year. I mean, is real estate doing well? Real estate's doing super well in the United States. It's never appreciated on a year-over-year basis faster than it has right now. CoreLogic just reported that the national U.S. housing price index went up 19.1%. It's never, ever, ever in the history of the U.S. been that high. So real estate's really cooking right now. So you got U.S. real estate going up at 19%. U.S. inflation's at 7.5%. If you believe the government figures, accept them, which they're understated. Real estate's still a good investment because real estate's going up 19% and inflation's, let's say, only going up, between 10 and 12. So it's still a good real estate's still a good place for your money. Is that the best place for your money? No, commodities is. Gold is. So sometimes you just have to be active, you have to be smart, and you have to adjust your portfolio for changing times. And that's what I do, even though the vast majority of my wealth is, in real estate, because I've owned it a long time. I don't care. I don't really care if it goes up or down. The home I live in. I don't care whether the home I live in is worth $1 million or $2 million. Does it matter to me? No. Has the size changed? No. Has the comfort changed? No. Not at all. And the only way that would change, guys, and this may be important for you guys up in Canada, because the advancing prices you've seen in Canada the last 10, 20 years, pale. Make California look small in comparison, or the United States. But the only way you're going to get ahead in life, let's say you sell your $2 million house in Vancouver and you move somewhere to a less desirable / less expensive place and replace your home for $500,000. I don't know where that would be in Canada. I don't know Canada. But I'm sure this place is there just like they are in the United States. And so you take your $1.5 million cash profit, you pay your taxes on it, you move to a less expensive place, and now you have $1 million cash to live on for the rest of your life and hope you don't go through that until you die. That's an advantage of living in an area that's appreciating rapidly. The only way to benefit from it is to move out. You can't move up. That just doesn't work. So that's the way you look at real estate. So everything's doing really well right now. Real estate's good. Commodities are good. Commodities are great. Gold's great. The stock market, looks to me like the stock market's getting ready to roll over. I know patterns. I've studied stock market patterns, and I don't like this pattern. But I will tell you, there's a big if here. If this World War III gets going in full gear, money's going to be flowing out of Europe and all these other, places that could be threatened. And there's one place they're going to go, and it's the U.S. They're going to go to the U.S. stock market, the U.S. real estate market. So that could keep the stock market afloat and real estate afloat for a long time. And it's called flight capital. And how bad's World War III going to get? Who knows? Sure off to a good start. I don't see either side relenting here. And now Russia's involved. Russia's a big player. They're not messing around. And so are we going to stand up to them? Maybe. If we do, I think we're off to World War III. So now what do we do? Well, then we'll have to recalculate. What does well during wartime? If we do well during wartime, I don't think inflation is going away, guys. No way. This inflation, the Federal Reserve Board has no longer talks about it's transitory. Nope. Those words are long gone. Long gone. Now they're saying they don't know what to do. They just come out, Jerome Powell said, I don't know what to do. I don't want to, what they don't want to do is their hands are tied to a large degree. The U.S. national debt is up to $30 trillion, which represents 120% of U.S. GDP. It's never been that high before. That's third world countries kind of numbers there. And so if inflation keeps roaring off, if we get into World War III, gasoline prices are going nowhere but up. So how high is the sky? Who knows? But we're sure going to find out. And so we're going to get into a stagflation type situation where we have little or negative economic growth, and inflation's going to be going off at 10+% a year. And so now we have to figure out how to survive those conditions. We're not there yet. In fact, if we get in those conditions, will commodity and gold do well? They'll sparkle. They will sparkle. How well would real estate do? That I'm less certain about, because if we start seeing high inflation, eventually mortgage rates are going to have to go up. And if the Federal Reserve Board of the United States keeps exercising quantitative easing, where they're buying all the deficit spending that the government's putting out there in order to keep interest rates super low, that's just newly printed money. That's all just getting injected into the system. Inflation is going to go off even harder than it is right now. More money chasing an equal to falling supply of goods. It's just pure supply and demand. So we're going to see. We're going to see how brave the Federal Reserve is to fight off inflation, because inflation's a real serious thing, guys. Real serious. And it's especially serious to the people that are of lower means, which includes about 90% of the people in the United States. So, I mean, you want to start seeing people scream. Wait till gas prices get up to $6, $7, $8 a gallon, and food's going off at 10% a year, and healthcare's going off at 10% a year, and your wages are only going off at 5%. People are already starting to cut back. I've seen the numbers. People stop going out to restaurants. That's the first thing that gets cut. Discretionary spending. You got to spend money on healthcare. You got to spend money on rent and housing and medicine and food. And and that's where people are having to step up the spending, and they're having to cut back from other things. And it's discretionary spending. So these are real interesting times, guys. And it's and don't take anything I'm saying as being negative. I'm really challenged by them, because that's life. We're always in a changing world. He who gets ahead and stays ahead is the person that adjusts most rapidly to change. That's what it comes down to. That's what Charles Darwin proved. And that's what it is. So it's an important job, and it's a job you gotta pay close attention to, or you're just gonna get run over by the bulldozer.
Gold and silver have been on the rise. What's your thoughts on gold and silver as we head into the spring?
Not so much in the spring. I mean, the trend is, I don't want to be that limited as far as that, but the trend is clearly up, and I think over the course of the next, near future, 1 year, 2 years, depending on how all this plays out, how bad inflation gets, I think one way to save the U.S. dollar, as opposed to raising interest rates, is to raise the price of gold and back the U.S. dollar with gold. Now you don't have to raise interest rates. All of a sudden you said, the gold's worth $25,000 an ounce. And the dollar's back 40% by gold. I mean, is that possible? Yeah. We have enough gold. We have 8,000 tons, or so the government tells us. And, we could back the dollar with gold, and now all of a sudden we won't have hyperinflation. It won't go up, because all of a sudden if they want to keep expanding the money supply and inflation keeps going up, at least they'll protect the bond market, Jim. They'll save the bond market. Because if you let inflation get out of control and nobody wants to buy U.S. bonds or any U.S. debt service because of rising levels of inflation, then you're done. I mean, the Fed can't buy the whole thing and just keep printing money. I mean, that's a road to ruin. Everybody knows that. They may try that short term, but long term that's not going to work. So you got to do something dramatic. And one way to help the situation is totally revalue gold to a much higher number and back the dollar with gold, or back the bonds with gold. Something. So people will still want to own them. I mean, who's going to want to own a 4-year, a 4% U.S. Treasury note for 30 years when inflation's running at 10%? The only way they'll do it, they'll say, the bond's back 40% by gold. What's gold doing? Going up. Oh, so it's a hedge against inflation. Absolutely. So at least you save the bond market. People are still willing to invest their money in the bond market, because when you lose the bond market, you're done.
What's the latest on California real estate?
California real estate, as a state, it ranks about, it's probably, in the last 2 years, let's start from 2020. 2020 to, to today, almost 2 years, California real estate is probably ranks number 7 on the list as the fastest appreciating states in the country, in the United States. Number 1, you guys will never guess what number 1 is. Montana.
I was going to say Montana. You beat me to it.
Good guess. Number 2 is Idaho. Number 3 is Arizona. Arizona housing prices went up 32.5% last year. That means they'll double in 2 years, based on the law of 72. So, in other words, California is up there. It ranks up there. It's doing really well, but it's not that. People are getting away from California to some degree. But everybody says, oh, everybody's leaving California. And by the way, number 4, what was number 4? I mean, I think it was right above or a little bit above or a little bit below California. It was the state of New York. What I read in the news is everybody's exiting California and New York because they're socialist states. They want to get away from it. How come they're the highest? How come they're up near the top of the best performing real estate states in the country? So that doesn't make any sense. That's why I don't believe anything the media tells me. Because I know different. I said, no, that can't happen. Everybody's exiting California for Dallas. The cost of a 26-foot U-Haul truck from Los Angeles to Dallas is $6,000. Okay, going from Dallas to Los Angeles, however, is only $1,000. Obviously, there's more demand going the other way. Therefore, you would think that Dallas is appreciating far more rapidly than Los Angeles, which is not the case. So it's just all BS. And, some of those indicators like that, I think the main value of that indicator is to promote U-Haul business.
How's real estate looking in the rest of the U.S.?
It's looking really strong. There's not one city, not one state, not one major city in the United States in the last 12 months that has not experienced year-over-year price growth. And that even includes North Dakota, which is right up near the Canadian border, right?
We always ask, is there really a need for a North and South Dakota?
Well, I don't know. I don't know about that, but I'm just saying that North Dakota has some of the lowest home prices in the United States, as a state. Alabama, down in the hard South, Alabama, Mississippi, Louisiana rank real close. But North Dakota, you can go to North Dakota and a house you would pay, let's say $150,000 for in North Dakota would cost you $800,000 in California. I mean, if we exclude the weather. So, I mean, there's a big benefit. If you can handle North Dakota, sell your home in California and move to North Dakota. You can live like a king. So, I mean, there is that, everybody does have that kind of social mobility that they can do that if they want.
The bank rate increased a quarter point in Canada this week. Is the Fed likely to also raise rates soon? Well,
that of course is a very great question. And I give you guys kudos in Canada for doing what's right. I think your inflationary rate is lower compared to ours, however it's measured. I think the U.S. is like 7.5 and you guys are like 5.5. Nevertheless, the Bank of Canada has the smarts and the courage to say, we can't let this go on. We can't let inflation run wild because it's going to ruin the economy. And what they have to do is this. They have to crank up interest rates to slow down demand, which will slow down inflation, and it'll cause a recession. No question about it. You guys apparently, I mean, we'll see how strong this need is, whether you'll stand behind it. But the U.S., I mean, we're in far worse situation than Canada, and they're talking about a quarter of a point move. So, but that's what they have to do. They have to raise interest. They either have to raise interest rate or back the currency with gold. By the way, Jim, how much gold does Canada own?
I would think, well, we have none. The government sold it all off at fire sale prices.
Very bad move. Like England. England did the same thing.
Exactly.
Bad move. So anyway, I'm just curious. I didn't know. Hey, for all I know, the U.S. may have sold off its 8,000 tons. It hasn't been audited in like 35 years, so nobody knows. So anyway, there's some hard choices, guys. And what we can do as, we have the ability to control what we can control. And what you can control, you can control, your lifestyle, how much money you spend, start cutting back on things, and where you have your money invested. You have control over those kind of things. So you're going to have to maneuver it. And I've always said, the best inflation hedge in the world is a skilled profession where you're better than other people. That's the best hedge in the world. So, I mean, just keep getting better and better and better at what you do. And you'll always be in demand. The unemployment rate could be 20% in your line of work. But if you're the best of the best, you'll have a job. And that's the first line. You have an income. So you're not going to starve. At least you have an income. But the other people that are not as skilled or as energetic as you are, they'll be out of work. They're much more vulnerable to hard economic times than you are. So it's a magnificent thing, everybody. The world is constantly changing all the time, and it's our job as human beings to adjust to those changes as best we can. And that's not only the best way to survive; it's the best way to get ahead. There's no other way, unless you're in government and you're in the back pockets of and big government's giving you money. I mean, big business is giving you money. That's how you get ahead. Which I don't like at all, of course. I just heard about somebody that he was a fairly wealthy man, he became I think it was a U.S. senator, a new U.S. senator. He came in with a net worth of $12 million. A year later, his net worth was $24 million. How'd that happen? I know exactly how it happened. You know exactly how it happened. But there's just a story for you. You know, these guys can front run trades. Obviously, he did something right. He was worth $12 million. So obviously, he can front. You know, it's not illegal for the Congress to act on inside information. If all of a sudden, you know, if a big business wants to get in favor with the senator or something like that, he'll call him and tell him, you know, hey, I'd like to have your endorsement on some of these things in the future. And tell you what, we're going to have a big announcement here in a month or two. And if you'd like, we'll tell you when that is so you can position yourself properly. That's how they get ahead. Not illegal. Of course it's illegal. You and I do that, we're in jail. They do that, it's just like everyday run-of-the-mill business.
Is inflation having an effect on real estate prices and construction costs?
Construction costs, yes. That's one of the things I'm going to be writing about. Construction costs right now, when we talk about services and material costs, went up in the last 12 months a little over 20%. That's not including land. That's just construction costs. That's a big number, guys. And that's one of the things that I'm thinking may be dragging housing prices up, 19.1%. Because what's a home worth? It's worth replacement cost. If your home burns down, what's the insurance company going to give you? Enough money to rebuild it. Yeah, well, construction costs are up 21% last year. Well, that's what you get. So, that could be dragging these things up. But interestingly, the price of new homes fell like 20% in the last reporting period. Because they're getting so expensive. New homes in the United States are I think they're 45% higher than they were during the 2005 peak. Existing home sales aren't even near that. But finally, with all these increases in prices, and the shortage of materials to finish houses, new home prices fell. They were up year over year, prior to that month, something like 20-25%. Now they're only up 4%. So I think you could see a big decline in new home prices strictly because most people can't afford them. They can't afford them. I think the median price home in the United States costs right now, I think it's a little under $400,000. A new home, I think it's $450,000. So pretty soon you just get who can afford it? Nobody can afford it. So the price has to come down.
Do new home prices affect used home prices?
Well, I think they may. Typically historically there's been about a 15% margin between, same type existing home, same type new home. New homes carry a 15% premium. And why not? They're new. Things shouldn't break down for a while. The roof's not going to leak, I hope. The water heater's not going to be replaced. The carpeting's all good. Everything's brand new. It's like a new car. Do you pay more for a new car than you do a used car? Absolutely. And it's the same with new homes. But now that premium, that difference in price has grown greater than 15%. But now that may be coming back down to normal and to the detriment of one, people that bought homes at the old high price, and two, the home builders that can no longer afford to produce homes because the demand is falling. So that's going to be an interesting dynamic too.
Do wars tend to affect real estate psychology, sales, and prices?
Of course they do. You know what? That's why any market is subject to the sentiment of the people that play it. If all of a sudden people started becoming more and more bearish on real estate, would prices go up? No, they'd go down. Same within the stock market. Same with any market. So, it's that situation where greed fuels greed and fear fuels fear. So that hasn't happened yet. But at some point, what will trigger that? Who knows? But obviously what you want to do, guys, and in my book, Timing the Real Estate Market, I mentioned 5 key indicators to watch. Those is all you have to pay attention to. I was at a real estate club meeting the other day, and everybody was worried about the war with Russia. And how that's the war Russia and Ukraine and World War III and how that's going to affect real estate prices. And what do I think? I said, nobody knows. But what you can do, if we're heading for a fall, just follow these key indicators and they're going to be the truest smoke alarms in the world if things are starting to get bad. So you don't have to sit here and, everybody debate about whether war with Russia is going to be good or bad for real estate. Because you don't know. Because that's just one constant. What's the Federal Reserve going to do? Are they going to start printing up money, just to pay for this, and inflation runs off the chart? If that's the case, it's going to be very bad for real estate because mortgage rates are going to follow. They're going to go way, way up, and that's going to kill the demand. But you don't know. So all you got to do, everybody, is you just have to keep your eye on the ball, follow the key indicators, and you're going to have a much better idea than a huge percentage of people about what's most likely to happen next in real estate. I can't say the same for stock market because I've never figured it out. I'm a short-term trader, not a long-term trader. And I'm not a buy and hold trade stock market guy. But if you pay attention to some key, early indicators, you're gonna see it coming. You just can't sit there and go, gee, this isn't happening. Yes, it is. You know that this indicator is highly correlated with price movement, right? Yeah. How far back? I don't know, 40, 50 years? Is that good? Yeah, that's real good. So why not pay attention to this indicator? And it's an early indicator. It's not a lagging indicator. Is it perfect? No, nothing's perfect. But at least you have an advantage. If everybody's going to get out of the market in 3 months from now because it's crashing, but you get signals that crash is early, that's going to happen earlier than other people, you can get out before they do. And there's your advantage, guys. There's your advantage. Do that and take care of your health, and you got the world by the tail.
From the outside looking in, how big is Canada's real estate bubble?
It's double, at least double what it is in the U.S. Everybody talks about the U.S. bubble. I've seen a chart recently in Canada in comparison. I think you guys, I haven't seen Australia or New Zealand. I understand they're crazy, crazier than the U.S. But you guys are up there. You guys are so sky high. Unbelievable. I don't see how you guys pull it off. Unless you have a better economy than we do. Maybe people make more money in Canada than we do down here. There's got to be some explanation because your prices can't be double ours if the incomes are equivalent. That just can't be. Nobody's going to spend, 65% of their net income on housing costs. Why? Because they've never done it. Because there's no room left for anything else. Food, automobiles, healthcare. Nope, none of that. Raising kids. Nope, no money for that. So I don't know what the difference is. I haven't studied it. I haven't studied it not because I don't have an interest, because it's not my market. My market is U.S. real estate, specifically California, because California is the big daddy. They're the big daddy. California real estate is the most expensive in the country, and it's more volatile than anything else. So that would be interesting for me to know how housing prices in Australia, New Zealand, and Canada have risen as high as they have. You guys must be making more money than we do. I can't think of any other explanation. It's pretty simple. It's got to be something like that. It's not magic act. So I'd be interested that somebody that knew that market, the way I know the real estate market in the U.S. I'd love having that discussion with them. But those kind of people are hard to find. And by the way, everybody, for those of you that haven't heard me speak before, I've been around the real estate business my entire life. My dad had been a home builder developer for 55 years, and I was literally born on a building site with a skill saw in one hand and a hammer in the other. I know this business as well, if not better than anybody. The ups and downs of the business. I was a builder developer myself for 10 years. Did really well with it, and somebody might, well, why aren't you doing that now? Because I'm older now, and to run any business well demands a lot of attention. And when I was building real estate, I was my own general contractor. I only worked for myself. I've never worked for anybody else. If you're good at what you do, only work for yourself. So I was my own general contractor. I was my own supervisor, and I was my own developer. It was all my own money. So the typical real estate project where a developer hires a general contractor, his profit margin is around 10%. Well, me wearing 3 hats and only doing one project at a time, my profit margin was 30%. So all I had to do was two semi-big projects a year. 8 to 10 unit apartment houses per year, and I was making over $200,000 a year. And that was in the 1980s. So I was doing really well. You don't have to be big, and do it on volume. I didn't want to do it on volume. I only wanted to do some select, developments every year, twice a year, and make a killing on each of them. I know. And so why don't I do that now? One, the risk is too high. And two, to do that, I was on the job site. The gates get open for the workers at 7 o'clock. I was on the job site at least 6:30, opening the gates. And when they left at 3:30, I was on the job site till at least an hour, maybe an hour and a half later, inspecting all the work with a can of spray paint of yellow fluorescent paint. So if something was wrong, believe me, I marked it. So the next day the guys show up, they go, uh-oh, Bob's been here. Of course he's been here. This is a mistake. You need to fix that. Don't build on this mistake. And so that attention to detail, you minimize your mistakes, and you make 30% a year. I mean, are you the biggest developer in town? Oh my God, no. Oh my God, no. Not at all. You're probably making as much money as guys that are doing, 20 times the volume you're doing. Because you have those skills, and you have the time to put into it, and you care, and you know how to build. You come from that family. So you can do it on your own, guys. You don't have to be a big time anything to do something really well. Just it has to have something that has a high profit margin, and where you can run the show yourself and do it all yourself, and just make, and by doing all those things, my risk was super low. The cost of those developments I was doing could drop by 30%, and I would still get my money back. Is that typical in real estate? No, not at all. It's just the opposite. Usually things like that, if values drop by 5 or 10%, you're underwater and you're in bankruptcy court. So, I remember those days, doing that kind of stuff. And I could do it now, but I don't want to do it now. I spend much more time in the gym and running hills. And, being on a job site at 6 o'clock and 6:30 in the morning does not allow me to be in the gym at 10 o'clock. Nope. And being in the gym at 10 o'clock is, frankly, at this point in my life, about 10 times more important to me because it maintains my health.
Well, I'm in the swimming pool at 7:30 every night for at least 45 minutes.
Well, you can't build a house. And that's great, Jim. That's great. I encourage everybody.
I mean, I finally found an exercise I really like.
Yeah. That's interesting. I mean, people ask me that, I have kind of long hair and I'm really tan because I run at the beach and run hills and only wear shorts and all that kind of. Everybody asks me if I'm a surfer. I've lived in Southern California my whole life. I am not a surfer. I don't like water, especially Southern California water, because it's cold, like 10 months out of the year. And I don't like being cold. Isn't that interesting? Never liked it.
I need 10 minutes in the hot tub before I get into the swimming pool.
So, but anyway, swimming is a great exercise. That's just not the one I choose. I just don't choose that. But, and another thing, see, you can you can swim your laps at 7:30 in the evening. You think I can build a 10-year apartment house at 7:30 in the evening? You think the workers are on the job? No, they're long gone. I gotta be there in the middle of the day. I want to run in the middle of the day. I want to be in the gym in the middle of the day. So, in other words, that's the price you pay. And it was a magnificent business. And it's what I did when I was young. I did that when I was young. And all of a sudden I graduated to the point and you go, you know what? That's just too many hours. I don't want to do that anymore. I can't do anything else but run that job site. It comes to a point in your life where making more money is a lower priority than taking care of your health. And I got in that position about 15 or 20 years ago. And even though I still love making money, no way in the world am I going to sacrifice my health to do that. So, that's what we all have to decide. But it's a magnificent business. You got to work out, guys. Us guys, we have to lift weights, keep our muscles strong, be healthy, have high cardio, all those kind of things. And all of a sudden, your life changes. You're just in a different world than everybody else. And that's what's more important to me right now. I'm much rather, even though I consider myself to be really, really skilled at real estate timing, and I know how to build, and the real estate business, better than most people by far. That's not my highest priority anymore. Even though I publish my timing newsletter. It's been published for 20 years now. It's a great source of income for me. But you know what I'm considering getting into? As many times as I've spoken on this show, Jim, House Street, I've probably had, let's say, 10 emails from people that have heard me speak. Of those 10 emails, 7 were on health and fitness and energy and how do I do it. I don't care. I could tell you how to turn hay into gold, and you guys wouldn't comment on it. You'd comment about how do you get so much energy? How do you stay so young? How do you do that? What's your secret? And so I'm considering, really, guys, as a new side hustle, getting into the health and fitness business. Not like the 30-year-old, but a 74-year-old guy that's in my kind of shape, with my kind of energy and my kind of health. That's a real rarity. I understand that, and I've been encouraged by readers, listeners from House Street. They go, Mr. Campbell, you have a gift. You should share that with the world. People would love to be like you are. And I'm thinking about doing it. See, there's another thing. If you walk the walk, you can talk the talk. Just like building. I can talk the talk because I can walk the walk. And it's the same in health. I can do the same thing. I'll put myself up against anybody that's my age and say, how'd you do it? Here's what you got to do. You got to do this, and this. And a few more things. Do I have to do them all? No. But you have to do this, and this. Is there any option? No. Okay then. I guess that's what we have to do. But it's been so interesting. I love being on your show, Jim, so much. But I'm just telling you what the feedback is. One guy emailed me the last time I spoke, and he said, Mr. Campbell, the way I looked at it, I had 2 emails. Both of them were on health. Not what's going to happen to inflation, whether you should invest in commodities or whatever. It was like, you have a gift and you should pursue it, sir. I mean, you just totally motivated me that this is what the focus in my life ought to be. And so sometimes the universe just calls out to you guys. When enough people are commenting on that, and you say, wow, and the reason they're commenting on, I'm not a 35-year-old stud anymore. I'm a 75-year-old man. But does that mean you have to slow down? Does it sound like I'm slowing down? No. So how do you maintain that attitude where you keep reaching and stay young and stay healthy and stay happy? Guys, there's a real formula to it. Believe me, because I've been doing this for 50 years, and I keep adjusting it so it's to my advantage. And everything I do with health and fitness makes my expertise in real estate timing that much better. That much better. It just makes you better in all ways. So you get smarter, you're healthier, and you can help people along the road. Not only help them make money, but more importantly, help them stay healthy. So isn't that interesting that I'm getting such great feedback from people that hear me on your show, Jim, and very little of it is on my real estate expertise when I've got a terrific model that beats anything. Nobody wants to hear about that. Everybody just wants to know how to be healthy, happy, and have a lot of energy. So that's kind of interesting. That even though I practice that myself, do I make any money from that? No. Have I written any reports on that? No. I just talk about it. People go, you should share that with the world, Bob. You should share that. So you never know, guys, where the world's going to take you. But all of a sudden, if the universe is calling, you got to follow it, whatever it is. It's just great and it's always going to be in something you have expertise in. Don't go for the money. Go for what you like and have expertise in. And the money will follow. If you're good at what you do, trust me, people will pay you money, a lot of money, to know exactly what you do. Exactly. And so why not? Why not share it with the world? So that's really interesting. I mean, my book, Timing the Real Estate Market, I shared with the world my formula that hasn't changed in 20 years. And I'm going to write another book. I promised myself I'd never do that again. It was the first book I wrote, the only book I've written. I'd never do that again. But I have doubled or tripled my level of knowledge about real estate timing in the last 20 years. So why shouldn't I share that with the world? What a wonderful gift to give to the world. Show them how to make more money in real estate by knowing the best times to buy and sell, or how to be more healthy. Whatever it is, you're helping mankind. And that's what it's about. It's not just about money, cheating somebody out of money, scamming somebody out of money, that kind of a thing, which is all too common nowadays. This is real old school stuff, guys. Go back to the basics, where you're really, really helping people. And so I really enjoy it. And I love the feedback I get from some of you guys. Trust me, it has been inspiring to me, and I'm listening to what you say, and I'm considering that. Maybe when I'm 80 years old and have six-pack abs, some people are interested how I achieve that. That's pretty rare. And a lot of people like that. Maybe you don't need six-pack, but you at least like to have a flat stomach, which is rare. I mean, in my book, you aren't in shape unless you have a flat stomach. That's pretty hardcore. Yeah. That's true. That's the way I believe. But there's things you can do, and you're working at it all the time. So, you got to be working on your health. You got to be working on, taking care of your money. You got to have a good job, and you can do that by being really good at what you do. And last but not least, guys, you have to have, for us guys, you have to have a woman in your life that you love dearly, that makes your life nothing but better. I'm not talking about nothing but better. That's really important. People that do really well, without that person in their life, it's fairly rare. It's fairly rare. You need that emotional, psychological support, and it really, really helps. Next question.
Are there any safe places to keep money?
Well, yeah. I mean, you can't keep money in the bank because, the bank's paying you right now, a savings rate of 0.25%, and inflation's going off at 10. There's a 10% loser. You do that for 3 or 4 years, the purchasing power of all the money you have, will be down by 35%. So you gotta put it somewhere. You gotta put it somewhere. And you have to be brave enough. Fortune goes to the brave. And that's why right now, aside from real estate, if you want some diversity, like in your 401k or, whatever, your retirement account, and you have control over that, it's gotta be in commodities and gold, guys. That's the best bet. That's what's going to pay, most likely, that's what's going to pay you the highest dividends. Is there any guarantees? Nope. But that's what you got to do.
In real estate booms and busts, do the prices of both the home and land increase and decrease together?
No, it's all land, guys. Home prices usually go up. The cost of improvement usually goes up at about the rate of inflation. I mean, even though inflation is now 7.5%, home prices are going up, at more than double that. I mean, that's really an anomaly. But what really goes up and down is the price of land. That's what's fluctuating. So ideally, here's what you want to do. Once you learn how to time the markets, assume you have building skills, or assume you have enough money where you don't need any income coming off of the property, like from a rental property, from a tenant, buy a piece of land. Look, let's say if housing prices go from $100,000 to $200,000 over a 10-year period. Okay? If you'd have bought the land and not the house, they would have went from $50,000 to $150,000, or maybe $200,000. You'd have quadrupled your money where you only doubled your money on the house. Now, why buy land? No, land's an eater. You got to pay property taxes. You got to keep it, maintain it to a certain degree. It generates no income, and most of the time you can't finance it, so you have a lot of money. But is that where you get the biggest bang for your buck in real estate? Absolutely. And then when you sell it at the peak, that's where you're going to get the biggest returns.
Do you think real estate stats are accurate?
Yes, I think it's accurate. You're more likely to rely on the indicators I follow, which is existing. These are my key indicators in my book, which are existing home sales, new home building permits, notice of defaults, foreclosure sales, and interest rates. If you can't rely on those, nothing is reliable. I mean, do I think that U.S. employment data is honest and reliable? No. Do I think production in the U.S. GDP is real? No. I think it's all contrived, controlled, manipulated by the government. But things like home sales, for a home sale to register, a deed gets recorded. Okay, that's a number you can count. Same with building permits. Before you get a building permit, you have to pull a building permit. And, you pay for that, and you can go out and count that down at the building department. Foreclosures. That's an event that occurs, when you foreclose on somebody, you have to file a notice of default. So that's more likely to be accurate than anything else. So I'm not afraid of that at all. I mean, but do I rely on U.S. government figures for inflation and unemployment? Not at all.
Is a college education important?
If you're in the right, yeah, I think it is. If you're a university, it's really important. That, if you're bringing the kids in and taking their money, yeah, but generally no. Generally no. If you need a college education, and you're going to be a doctor, engineer, I would guess that maybe 30% of the degrees produced by universities and colleges have economic value. The rest do not. So it has to be something where you're skilled. I mean, I guess you have to teach you to be an engineer, how to use a slide rule and things like that. Doctors have to be taught. You're not going to do that on your own. But generally speaking, Like, would I go to a university to get a degree in business? Not in a million years. You want a degree in business? Go work for IBM and in sales for 5 years. That business education will be worth 10 times what you paid into college for. Get out in the real world, guys. That's the way you learn. It's just kind of like swimming. Do you think you are going to learn how to swim by studying water dynamics at the university? Or do you think you're going to learn how to swim by jumping in the water? Same thing. Same exact thing. And people think that there's this, back 20, 30, 40 years ago, a degree had some value. It doesn't nearly have the value anymore. First thing they're going to ask you is, they're going to talk to you and figure out if you know how to think. They go, well, yeah, I have a master's degree from Cornell. Okay. What do you think about this? I think this. How'd you come to that conclusion? Oh, because that's what they taught me at Cornell. That's the sole reason? Have you thought about it on your own? No, I don't know how to do that. Thank you, sir. We'll call you if we're interested in you.
How important is health?
I'm telling you guys that, from the bottom of my heart, the healthier you are, the happier you are. The healthier you are, the more successful you're going to be. Because the healthier you are, the better you look, and it makes you more confident. The better you feel. And that shows. It shows, guys. You can't, money can't buy you good health or good fitness. You can't do it. It has to be paid for. The price is paid for by you. And you only can control that. But I'll tell you, just being able to do some of the things that I can do at my age, it's really unbelievable. And it's so empowering. And I invite you all to join me. And you'll see how empowering it is. I can do these things. I go to the gym, and I'm telling guys, what I'm doing right now. I'm practicing to be play hardball, baseball, fast pitch. They go, oh, I can't do that. I can't do that because, guys, even 10 years younger than me, because I have bad knees. I've had surgery on both knees. And I look at them and say, yeah, I've had surgery on both knees too. How come I can do that? In other words, it has to be a determination, guys. You don't let anything stop you. Nothing. I mean, yeah, if I needed 2 replacement hips for some unknown reason, could I play baseball or anything? No.
No, you'd have to join me in the swimming pool, Bob.
What?
I said with replaced hips, you could join me in the swimming pool, though.
I don't like to swim.
Aw, it's too bad.
I know. I'm not that kind of an athlete, Jim. Why do I like baseball? Because it's a power sport. You can hit the crap out of a baseball.
I like the team aspect.
A long ways. You think that's satisfying? You're damn right it's satisfying. But I mean, unlike basketball. Is basketball a power sport? No. Is football a power sport?
Ooh, yeah.
Throwing, catching a football? Not really. No.
You ever played on the line, though? It's a strength sport. Or running back?
Well,
yeah.
I know some of that. But I'm talking about that, it's just not pure strength. I mean, hitting a baseball or something like that. Or like even tennis. I used to play tennis because I turned tennis into a power sport. I was an in-your-face tennis player. I would serve the ball, and I'd serve it hard, and I'd go rush to the net, because when all of a sudden you could barely get it back to me and popped it up in the air, I would jump up in the air like a volleyball player and try to hit the ball straight down where it hit the court and then bounced over the fence.
How can people find out more about your book and newsletter?
Oh, sure, of course. They can go to realestatetiming.com, realestatetiming.com. And you can find out about buying my book, my newsletter, and I've had quite a few subscribers that have called me from Canada. And you know what's interesting? For me to send one of my books to Canada, I think the book costs $40 or something like that. To send my book to any place in the United States, it costs me $4 with media mail. To send that same book to Canada, where there's no media mail, it all has to be sent first class mail, it costs $22. But believe me, you guys, I'm grateful to you guys. Isn't that interesting? Do I ever squawk about it? Not at all. Not at all. Isn't that interesting? It costs like almost 6 times as much money to send it, to a place any place in Canada as it does for me to send it all the way across the United States. So anyway, that it's, that I assure you that, anybody that has a serious interest about, making their way in this world by making the best timed real estate decisions, my book will be a wealth of information for you. And if you don't feel that way, send it back to me, and I'll send it back to me for $22, and I'll refund you $40. It's that good, you guys. So, I really appreciate, those of you that reach out to me and, about a variety of things. And this has really been a good audience for me, Jim.
Bob, thank you so much for being on This Week in Money.
You're welcome. I'll talk to you again soon, Jim. Bye.
My guest has been Robert Campbell, publisher of the realestatetiming.com newsletter. He was speaking to us from San Diego. Coming up, Steve Saretsky, next on This Week in Money.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Steve Saretsky. He's a Vancouver-based realtor online at stevesaretsky.com, and no doubt he's speaking to us from Vancouver right now. Welcome back to This Week in Money.
Yeah, no worries. Thanks for having me on.
Steve, has the latest issue of the Saretsky Report been released yet?
No, we're still working on that. So we got my homework cut out for me here this weekend.
And when can we expect it to hit us online?
I should have it probably by Monday. So I should give everybody a pretty good update on the state of the housing market here in Vancouver, but happy to sort of jump into that, and perhaps we can kind of give an early preview here.
This week, the Bank of Canada raised the bank rate a quarter point. The last time the Bank of Canada hiked its rate was 2018. With high inflation, is the Bank of Canada likely to be more aggressive with interest rate hikes this year?
I think, obviously that's the consensus view. My opinion is I'll take the contrarian side of that, and people might say, well, it's because he's, in real estate and that's in his best interest. Fair enough, but I'm just looking at it from a objective view here and saying, okay, well, you've got obviously record, 30-year highs inflation. We can look more recently here what's going on. Okay, so you've got gas prices going up, $2 a liter here now in the Lower Mainland. You've got food prices which are rising, and they're going to continue to rise with this war outbreak. Obviously, Russia, Ukraine are responsible for a lot of the world's grain and fertilizer, et cetera. So you're looking at this and saying, okay, well, you've got, structurally, I think you've got some inflation, gas prices, food prices, and now we're raising debt servicing payments on one of the most indebted household sectors in the G20. And so I'm trying to think of what's the bullish outlook here for the Canadian consumer, and how much interest rate hikes can they actually withstand without sending us into a recession. And so I think that's where we're going ultimately. Is I think the Bank of Canada is actually beginning to tighten their interest rate policy at a time when the housing market is actually already just beginning to turn, in my opinion. I think we've actually just started to peak out. So they're well behind the curve, so to speak. And my view is I think that these 6 to 8 rate hikes I think are wildly optimistic. I think you're already starting to see a slowdown, and I think that inflation here and the housing market slowing down is going to start to bite into the consumer, and I think we're going to enter a recession before much of the market anticipates.
How are the mortgage markets reacting to the quarter point hike by the Bank of Canada?
As expected, you've just had your 25 basis point increase in your variable rate mortgage. So I can kind of break that down a little bit further for anyone that's listening. It's important to contextualize and understand, because this is most people, I think even a lot of people in the industry don't understand this. Just because variable rate, so variable rates are based off your prime rate. Your prime rate is essentially based off the Bank of Canada policy rate. Just because variable rates are going up 25 basis points does not mean that your mortgage payment is going to go up and increase. Because a lot of the big bank products have fixed variable payment mortgages, which means the Bank of Canada can come out and raise 100 basis points. Your payment will not change. The only thing that is going to change is that the amount that's getting paid every month is going to be less of that payment going towards your principal pay down. So roughly, give or take, there's not an exact number on this, but for simplicity's sake, it's about 50%. So 50% of variable products out there have structures where the payment will actually increase. And so to give you a little bit further context, on $100,000, for every $100,000 of mortgage debt that you have that's variable payment, you're looking at about a $12 to $13 monthly increase on your mortgage payment, assuming that you have a variable rate product that is not fixed. So anyways, hope that sort of explains things a bit further.
Mm-hmm. And back in the 80s, when we had 18% mortgages in some cases, all that happened was more of the money went to pay the interest rate, less went to pay down the principal. So effectively, it just takes you longer to pay off your mortgage, but you're not paying more a month. Would that happen again?
Yeah, I mean, it's pretty much like in today's rates, right? I mean, like, I've got a variable at like 1.2%. I mean, okay, at that rate, 65% of my initial payment is going towards paying down the principal. So now as rates go up, my payment is going to stay the same, but the amount that I pay down each month into principal is going to go from 65 to 60 to maybe that gets down to 50%. I don't know, but obviously rates are still insanely low. You have to look at a lot of these variable rate mortgage products today and say, okay, well, we've had a lot of people locking in at 1.2. So even if the Bank of Canada raises hypothetically 100 basis points, you're still at about 2.2, which is still lower than your 5-year fixed rate mortgage, because your 5-year fixed today is about 3%. So there's still a huge gap. And I think that we will see that gap start to narrow a bit as the Bank of Canada raises rates. But again, as I said, my opinion is I don't think that they're going to get nearly as far as the market's anticipating. I could very well be wrong. That's just my opinion.
At the Bank of Canada meeting this week, were there any indications of what lies ahead?
Yeah, I mean, I listened to the presser, and I mean, I think that these are all these pre-scripted. I think that there's a lot of political pressure to tackle inflation, so I think that they have to act tough. But I think the reality is, if you look at the debt picture, they can act tough, but I don't think they're going to be able to, actually enforce toughness. Which I mean by that is, so much of central bank policy is about, moral suasion, right? I mean, just the thought, just central banks acting tough and saying that they're going to raise rates, 5, 6, 7, 8 times automatically changes consumer habits. So I always turn back the clock and say, remember at the onset of the pandemic when they dropped rates to zero, Tiff Macklem came out, he said, we're going to keep rates at zero. Rest assured, if you're going to go buy a big house, a boat, you start a business, rates will stay low for a very, very long time. So he's very careful with his words. That was basically the green light to go speculate on real estate. As we know, national home prices ripped to all-time record highs, rapid, 30% price growth annually. And now they're coming back and saying, okay, we're gonna continue on this rate hiking cycle. Canadians need to be prepared. And so that's kind of the message today, and we're already starting to see that, right? Like we see that change in consumer habits in the housing market. People are saying, well, you know what, maybe I don't need to rush out and buy that detached house anymore. Maybe I can just wait. Interest rates are going up. I think there's going to be an opportunity here in the next 3, 4, 5, 6 months. You start to see that change. And so I think that that's really the Bank of Canada's message today. I think, yes, I think we are going to see more interest rate hikes. But again, my view here is that a lot of the tightening is going to come not only from the forward guidance from the Bank of Canada, but also from everything we just talked about, which is, rampant inflation, gas prices, food prices, and now you tack on higher debt servicing payments. I don't see how an indebted household is going to not pull back on their spending. And I think that's going to be ultimately recessionary.
So are we at the turning point for real estate sales and prices?
Yeah, and with some caveats. I think that prices, depending on what you're looking at. So I think that COVID trade, which is that detached house in the suburbs, in my opinion, from a lot of the things that we're seeing on the ground, I think those prices have peaked. That might not show up in the data for another 2 or 3 months, but everything that we're seeing, houses that used to get 8 offers are now only getting 1 or 2. Some houses not getting any offers. And so we're starting to see that pull back. I think you could make the same argument for, townhouses in the suburbs that have basically doubled in the last 2 years. I think where you're starting to see some actual price acceleration is actually in the inner city condo market. And that was the market that was ultimately left for dead over the past 2 years. So you're starting to see sort of as the pandemic comes to an end here, as we start lifting all these restrictions and moving on with our lives, I think that you are starting to see some of the pandemic-related housing activity is starting to reverse.
Could the Russia-Ukraine war end up affecting real estate prices in Canada?
I mean, I think as a knock-on effect, yes, in terms of, okay, I mean, I think the Bank of Canada even mentioned it too, right? I mean, everyone's well aware that, those two countries are pretty rich and, commodity rich. And, that's resulting, as we can see over the last, 2 weeks alone, gas prices, food prices. So I think that's going to put more inflationary pressure. That's going to put more inflationary pressure on Canadians, which I think ultimately puts more pressure back onto the Bank of Canada. So it's kind of like you're damned if you do, damned if you don't, right? I mean, I don't think the Bank of Canada raising rates necessarily, again, is that going to solve commodity prices? Is that going to fix supply chains? Probably not, but there's political pressure. They have to move. They're so far behind the curve. But like I said, I think all these headwinds are coming together that, again, I don't see a positive outlook if you're a Canadian consumer here.
As you mentioned, in Vancouver, we're paying over $2 a liter for gasoline. That's almost $8 per U.S. gallon. The highest prices we've ever seen, a lot of it because of our super high taxes in Vancouver. But my question is, are there any correlations between record high gas prices and the real estate market?
I mean, not that I'm necessarily aware of. I mean, on the top of my head, I mean, obviously I think that they coincide with typically higher inflationary environments. I think real estate tends to do better in inflationary environments, or at least tends to sort of preserve some of that wealth. But yeah, I mean, I don't have a direct correlation here of oil prices. I think there is pretty good charts and data out there, and obviously great commentary online here. All you have to do is, sign up for a Twitter account and you can follow some pretty intelligent people, but, it doesn't take an overly intelligent person to put two and two together, which is, higher oil prices, typically lead recessions, because ultimately oil is the blood of the economy and it goes into everything in our day-to-day lives. And so that higher input cost ultimately, trickles down into the consumer and it starts to bite consumer growth. So that's all in simple terms. That's just how I'm looking at it. It's just saying, okay, you've got an indebted household and you've got these input costs continuing to go up. And not only that, the input costs, which is their debt payments, which is a huge component of household balance sheets. Those debt payment, costs are now starting to rise thanks to higher interest rates and obviously the Bank of Canada pivoting course here and we're starting to raise interest rates. So all this is kind of coming home to roost, and so that's just how I'm looking at it, and that will ultimately feed through into the housing market. Keep in mind, housing is a very slow-moving, lagging indicator. It takes time for these things to filter through. Sellers don't start dropping their prices after 5 days and because they don't have an offer. It takes time. And so I think, as I've talked about throughout the beginning of the show here, is that we're seeing signs that the housing market is starting to shift. We're seeing signs that buyer demand is starting to slow. Now, don't get me wrong, it's still an extremely hot market. It's still an extremely tight housing market with very, very low inventory. We're coming off of all-time, record highs, a lot of frothiness. So we're not going to go from a record hot seller's market to a buyer's market in 4 weeks. That's just not how it works. But we are starting to see the psychology in the market starting to change. The psychology back in December, January was, oh my gosh, house prices are literally going up 5% per month. My house just went up. House that I was looking at in November just went up here in January by $150,000. I better just throw everything I got at this thing, because if I don't buy here in January, who knows what the price will be in March. I might not even be able to buy a house at all. I might have to go down to the townhouse market. And so that was the mentality. The mentality now is starting to shift. It's like, hey, hold on a minute. Yeah, it looks like the market is kind of starting to change. Maybe I should just watch and see how this starts to play out. And so that's really what's happening.
Are listings picking up as spring approaches?
Yeah, they always do. So this is nothing like unusual. It's not like we've got more than normal listings coming to market. We just have seasonally March, April, May, your busiest times of the year for new listings. And so again, those new listings will come to market here over the next 3 months at a time when I think buyer demand is starting to wane.
What's been happening in home sales for high-end, mid-range, and low-end homes?
All of them are moving pretty well. I mean, obviously, like the bulk of the activity is at the low to, the entry level to really the entry levels. I mean, that's been the hottest segment of the market. Detached, depending on your submarkets. Every submarket is different, right? So like a house in Langley, that entry level point is, 1.5 million. In Vancouver's west side, that entry point is 2.5 million. So any of those price points where you've got sort of the entry level house, those have been the hottest segments. Entry level condos, one bedrooms, $500,000, $600,000, very, very hot. Townhouses under $1 million, incredibly hot. That's where you've seen the bulk of the activity, because as we've talked about in the show numerous times, is that this housing cycle in particular has been driven by end users. It's been driven by changing consumer preferences because of the pandemic. So people ultimately wanting more space, moving out to the suburbs. That's been the driver of activity. And I don't, everybody wants to blame investors, but, I've got news for you. There's not a lot of investors. I mean, seriously think about this. There's just not a lot of investors out there that are willing to buy houses for $2.5 million and collect $4,500 a month in rent. The numbers don't work. It doesn't make any sense. And so that's not what's driving, the single family housing market. It's young families that are looking for more space and working from home.
So, investment buyers, not much of a factor. What about foreign buyers of real estate in Vancouver? What's happening there?
Yeah, I should caveat that. The investors are obviously active, but they're active in the condo market, particularly, one bedroom condos under $600,000. They tend to compete a lot of the time with first time home buyers. That's where the investors are predominantly. I just don't have a lot of investors that, again, at $2 million price point to collect $4,000 in rent. It's just, the numbers really don't work. And that's kind of where you're seeing the activity. Obviously, the pre-sale market tends to attract a lot of investors. So you're seeing investors quite active in that space right now. In terms of foreign investors, really not seeing much at all. I think that's been the case throughout the pandemic. This is not like 2015-16. I would argue that a lot of the money from China is actually going back to China, not actually coming in. I think that as we can all see, the world is changing. This sort of globalist, open markets, open borders. I think everyone's becoming sort of, it's protectionist, it's nationalistic. COVID, you've seen a lot of foreigners move back home to get back closer to family. I think everyone's well aware too in China, it's not really easy to come and go and in China when they've got, COVID zero policy, you got a quarantine for 3 weeks, they aren't coming here and snapping up all this real estate like they were in 2015-16. So, again, a much different market.
So what are foreign owners of real estate in Vancouver doing right now?
It's important to contextualize because there's offshore money here. It's always been here. The problem is a lot of them are Canadian citizens and permanent residents that already live here. So, they're kind of just going about their day-to-day lives. I wouldn't say they're ramping up investment here. But we are starting to see, you just see more and more stories of who's selling? Okay, well, we either moved back to China or they're stuck in China. And so they're selling. And that's a very, very common thing that we're seeing today.
What could keep the real estate boom going?
I don't really know. I think I've been fairly bullish over the last, 12 to 18 months. I had a view and I sort of stuck to that and that played out. I'm not in the camp of, I don't have a bullish outlook here. As I talked about at the beginning of the show, I think that it's hard to be optimistic on the Canadian consumer here, in the near term. So I think the only thing that changes course here is the Bank of Canada dropping their policy. I think that, we ultimately get closer to a recession and liquidity or financial conditions start to tighten and they have to ultimately reverse course. And you then begin easing in an inflationary environment, which is kind of counterintuitive to how central banks are supposed to act. But I mean, that would maybe be the bullish argument if that was to happen. That's not really my view and base case scenario. I think that central banks here are going to tighten into a recession. They should have been hiking, 6 to 10 months ago. They waited way too long, and I think now that all these factors coming together are going to slow things.
Due to the freezing of a few bank accounts by the banks at the request of the Trudeau government, has faith in the Canadian banking system been damaged?
I think it's had an impact. I mean, just chatting with, my network, I think there's some extremely well-connected individuals that I've chatted with that are also very, very high net worth individuals that, you chat with these people and say, well, I mean, we have to think of the world in a little bit of a larger lens, which is global capital can pretty much place itself anywhere in terms of investment. So it's always looking for safe havens. I think that's more true today than ever, right? I mean, that's why there's a premium on U.S. equities, because at the end of the day, it's the world's global reserve currency. It's a safe haven. What you do is look at, like what's happening with like Russian stocks, emerging equities and stuff like that. So, I think that it creates a bit of hesitation. That's all I'm going to say. I don't think it's like catastrophic. I think people talking about bank runs and all that is kind of ridiculous, but I think there's some hesitation in general. Then, okay, like maybe we just do a second ponder here of how much capital we're placing in this country.
When money starts to flee a banking system, does it usually result in higher interest rates in that country?
I mean, yeah, sure. If you're an emerging market, I mean, again, I think to start placing Canada in that conversation, I think is ridiculous. But, certainly in emerging markets, yes. Canada is still considered a safe haven. It's still a democracy. I think there's some things that concern me, but, in general, I'm not concerned about, us becoming an emerging market.
With tyranny and the loss of rights in Canada, could there be an extra risk in the real estate market?
I don't think so. No, I'm not looking at that. I'm not seen, heard anything like that. No, I don't see that.
With the push on for Agenda 2030, the Great Reset by the Trudeau government and other governments around the world with the slogan, "You will own nothing and be happy," to achieve their evil goals, would they likely target the real estate market?
I don't know if they're targeting the real estate market. I think what's happening is, again, I don't know. I don't necessarily play into, whole conspiracy theories, and I think there's an element of it. Is there some, grand puppet there? I think we're giving these people more credit than they deserve. I don't think they're as smart as people make them out to be. I think politicians are actually pretty inept. So to be able to actually construct some grand master plan, I think is giving them a bit too much credit. I think that as we're starting to see, though, I do think the whole "you'll own nothing and be happy." I mean, I think that we're clearly seeing and entering, and I've been talking about this for a couple of years, is that this is and has been the largest wealth inequality or wealth driver. Hammering rates to zero and printing trillions of dollars. I mean, it's created obscene amounts of inequality over the last couple of years. So the gap between the haves and the have-nots, I think is growing, and I think it will continue to grow. So that's kind of my only view to that.
Here in March of 2022, would you be a buyer or seller of real estate?
It depends what it is. I would think in general, I'd probably be looking on the sell side. Again, this is if you're trying to time the market, again, detached prices, as I said, if you were looking to sell, you probably missed the top by about 6 weeks. So that probably would have been the best time to sell, at least in hindsight here. We don't know what's going to look like moving forward, but that's certainly my opinion. Again, I still think there's pockets in the market that are mispriced. I think I look at, 2-bedroom condos in downtown Vancouver, they're still trading below 2018 prices. They haven't moved. And so I think that's arguably a portion of the market that is still mispriced, particularly if you believe in this end of the pandemic. I think there'll be a significant portion of society that goes back into the office. I think that's potentially a compelling trade there. But yeah, I would say there are large portions of the market I would probably be selling.
Governments say that they're for affordable homes. Well, what can government do to make homes more affordable?
I mean, I don't think there's a lot they can do other than, getting out of the way. I think that the bureaucracy, the red tape, the taxes, these are all input costs into housing. So I think that's probably the only thing that they can do. I think the biggest driver of house prices is ultimately the cost of money. Again, you can raise rates and crush the housing market and have a 30% sell-off. That's the only way to do it. I don't think there's any political stomach to do that. I think that given the amount of debt that we have in society today, I just don't think that's a plausible scenario or outcome, unfortunately. And so it's hard to really pinpoint how this will all play out.
Toronto home prices are now higher than Vancouver. I don't know if that's ever really been a factor since maybe mid last century. Why is Toronto now more expensive than Vancouver?
Yeah, I don't have an answer for you. I think that I think people in Toronto are very optimistic and enthusiastic about the housing market, and perhaps too much. So, I mean, I think that's all I can really say to that.
I was going to suggest they finally open more legal marijuana stores, but that would just be a joke.
Yeah, it could be that too. I don't know. I think that I think there's a lot of speculation in Toronto. I mean, I could be wrong, but I think that they have a little bit more land mass to spread out anyways. But I mean, it is what it is, I guess. I don't know if it's good for them or bad for them, but surpassed Vancouver. So there it is.
How can people get in touch with you, and how can they get the latest issue of the Saretsky report?
Best way just to be email me, Steve at stevesaretsky.com. And, the Saretsky report's free on my website, stevesaretsky.com as well. So we put that up every month. So that's the best way.
Steve, thank you so much for being on This Week in Money.
Thanks for having me on.
My guest has been Steve Saretsky. He's a Vancouver-based realtor online at stevesaretsky.com. You can find him on Twitter at Steve Saretsky. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Robert Campbell, and Steve Saretsky. And thank you for listening. If you have any questions for our guests or the show, you can send them to info@housestreet.com. Now stand by for a company showcase update from American Manganese CEO and President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HouseStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Well, thanks, Jim.
Larry, with the price of gasoline in Vancouver hitting $2 a liter, well over $7 a gallon if we're buying U.S. gallons, that must make chat about electric cars and the recycling of their batteries a hot topic these days.
Oh, for sure. I mean, if you can drive an EV car like a Tesla, you're saving a lot of money on gas. It's just goes without saying. It's only going to go higher, and it's certainly three staff in here have Teslas, so they're saving money, and aside from me, but that's okay. I usually use my car for work, and that's about it. So, but once a week you fill it up. It used to be $45. Now it's $90. So what can I say? And but anyway, that'll help push the sales of EV cars, which is the fastest growing industry out there. And certainly again, I got to take my hat off to Elon Musk. As far as I'm concerned, he pioneered that, went through the tough times, and now he's up there enjoying the good times, and so he should. So it's kind of like recycling. When you're recycling, you want to have patents on the technology that you're going to be using, and you want to have those patents fairly widespread. And that's exactly what we've done. We've focused on the metallurgical side of it. And just to back up a little bit on that, a lot of people are doing black mass, including the OEMs, and our technology allows us to take any black mass and to work it into a cathode precursor, and the lithium line. So, you know, that's R&D. That's what R&D does for you. I just received an email this morning that says all we do is R&D. Why aren't we moving ahead? Well, I guess building the demonstration plant and getting it going is not moving ahead, and according to him. So what can I say? I mean, if you want to check out on the competition, go ahead. You know, everything's out there. There's an internet. You can look up patents. You can do all kinds of things. And but don't phone me up expecting me to do your homework for you, because I don't want to go down those rabbit holes. I want to stay focused on what we're doing, and focus is where we got today. We're not very far away. We'll probably have the first production of any North American company, and that's from the metallurgical side of it. So that's a big feather in our cap, and that's coming down the pike. So what can I say, Jim? It's a competitive world out there. There's lots of companies claiming that they're going to build a recycling plant, a metallurgical plant, although they got nothing that says that they've done the work to design that plant. And we're getting a lot of NDAs from big multinational companies, and they're starting to see the value in what we're doing. So, you know, you got to be patient. You can't be pushed by somebody trying to get you off center, have you running around, you know, going down rabbit holes, checking out the competition. Competition will do what the competition does. And so you just, you know, keep your head down, your ass up, and you keep working on developing a product at the end of the day that satisfies everything. People seem to forget that we have a closed circuit, and so there's nothing getting back into the environment, and that's where we want to be. So, you know, we've developed that some time ago, but we've made significant improvements on our technologies. As I just told you about the black mass, working with black mass, we've worked with about a dozen different companies, black mass, and we're able to handle that with all their impurities and contaminants that are in that black mass. We're able to work our way around that and come out with a good cathode material at the end of the day. So I think we're doing the right steps. You know, maybe we didn't get into the black mass market. Might have had a bump in the stock up to over $1 or something like that, but we'd be facing losses right now. And the company's well financed to get through this difficult time. You know, we've got things that influence the market that we didn't have 3 months ago, or 2 months ago, or 1 month ago. You know, like Russia. Basically that is disturbing the markets. It really is. Gold's up, commodities are up. You look at nickel, it's up to over $13 a pound now, which is getting pretty close to $30 a kilogram. So, you know, commodities are doing very well. And there's a fear there's going to be in short supply, especially nickel, especially lithium and cobalt. But that's a temporary influx in the market. You have to remember that when you're doing deals out there, that you have to work with the company that's going to be supplying you with the material and getting it back or buying it back, and you're not going to be looking at those high prices. So you got to make sure your I's are dotted and your T's are crossed. Then you move on from there, Jim. It's what can I say? It's really, it's a matter of tedious work. It's a matter of getting it done right, and it's a matter of having the right partners to do it. And so it's we're moving along with that. My voice sounds a little shaky. It's one of the last things coming back after you've had pneumonia. You do have lose some lung capacity, and so it's I apologize for that. But the main thing is I'm very enthusiastic for what's happening out there, and I think that we are we're really on the right track. I think a lot of companies are beginning to recognize that, and we're being romanced by different groups that want to finance the company. But let's not get our horses in front of the behind the cart. Let's get them in front of the cart. So we got to know exactly what's happening. And I've included in this podcast that half a dozen different write-ups on short selling. And that's all I'm going to say about it. People can go to those articles and see them. Just click on the links, and you'll see that just a deluge of them came out this week. And so it's one of the things that people like to hear is what's happening with the demonstration plant. Well, we're doing the water testing right now. That's all I can really say. Hopefully we'll be able to, show the full operation of it here soon and put that out in a video so that people can see how the plant is working. And it's not a small plant. I mean, this is not like the pilot plant, which was quite contained and quite small. This is more of a spread out plant, like a normal operation. And, because we're going to be doing a lot of material through there. And so it's, and again, I'm hoping that we can bring it down so that we can actually resell the product at a gain. And but that's a guess on my part. So it's I think everybody's enthusiastic about that. But until you do it, you can't really say that you can do it. But it would be a nice feather in our cap again to have the first production from a plant that actually makes money. So that would be a fantastic way to go. And we'll have an update on our projects up at Rocher de Boule sometime next week, and our permitting. Are working to get the permits done. So it's just an ongoing situation where you have to keep on top of everything to make it happen. And being on top of it, you got to be on top of everybody on the line, so that you've got the right people in the right places that are pushing these projects through. And that's one thing I've learned as a 40-year veteran of CEOs of public company, as a CEO of a public company, that you have to have the right people doing the job. If you got the wrong person in there, that can really blow up in your face. So we try to keep away from that, and we try to keep the progress going. Sure, it's taken us a lot of time for R&D, but we've got a lot of patents out there, and that means that the reality is that we've been successful in the work that we've done, and people shouldn't be complaining about that. It's if they are, are they trying to get me to run down rabbit holes? What's their agenda? I don't know, and but that's not going to happen. And I'm not here to evaluate everybody's project. Usually quick phone call with Cometco, and checking out some patents once in a while. It gives me a pretty steady feeling that we're way ahead of everybody else. So that's all I can say about that, Jim. It's coming up to the weekend again, and I wish everybody a great weekend. And I hope that everybody stays healthy and safe. So I'm going to sign her off for now.
Larry, before we go, could you just give us a little idea about what American Manganese is all about for people who may not know about the company?
American Manganese, which is soon to be have a name change to Recyclical, is a company that got involved in manganese back in 2008, and we developed a process over a 4-year period, actually a process over a 3-year period, and followed up by feasibility studies to bring low grades of manganese into production in the U.S. And to say I'm disappointed about, not renewing the contract with the DLA would be an understatement. It's, it's something that the U.S. needs, and, we're trying to find out just exactly what numbers they were working with, et cetera, that they didn't want to proceed with this thing because that, in our point of view, doesn't make sense. And so, anyway, that's where our roots are. We took the cornerstone of our battery recycling from the patented process we have on manganese, and now we have several patents in several countries, and those patents will pay off for the company in the future. I know that people now, they like to say, well, patents are no good. I mean, how do you police a patent and all that? Well, policing a patent is not that bad. If somebody's out there producing similar results to you, then, a quick look at the operation will tell us if they're using our patented process. So, patents are the only thing that protect you. The only thing that really protects you. And, if a company is, for example, wants to go into patent infringement, then they stand a chance of losing their total investment, the fine with everything else. And that can happen. And it has happened in the past. So it's something that we plan to police and enforce. And, it won't be that difficult. There's going to be a few companies out there that will be starting up their own metallurgical process, and we'll be keeping an eye on all that. It's not that, they'll be using peroxides or solvents or whatever, which does not infringe on our patents. And, but it doesn't get the same results. So that's where you can look at the history of the company, look at the history of the board of directors, look at the history of the management, and you can see that that we've moved in the right area at the right time, and the timing seems to be perfect. So it's not like we're racing to the finish line here. We didn't get involved in producing black mass, because, as I told you, we can adapt the black mass wherever it comes from, whatever impurities it has, whatever it has in it, we can adapt that to actually producing, top-notch cathode materials or cathode precursors. So that's what I got to say about that. You can find out everything that we've done is in press releases and everything that's on our site, and it's AmericanManganeseInc.com. And if you want to talk to somebody here, you can phone me at 778-574-4444, or you can email me at LREAUGH@AMYMN.com. And if you want to follow our stock activity, you can follow it on the Toronto Venture Exchange under the symbol AMY. You can follow it on the QB board under the symbol AMYZF, or you can follow it in Europe under the Frankfurt symbol 2 a.m.
Larry, thank you so much for the update.
You're welcome, Jim.
We've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on March 4th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.